Welcome. In this explainer, we're going to break down the essential process of end-of-financial-year adjustments. We'll be using the FNSACC421 case study and the Zero accounting system to walk through all the key procedures.
So we'll be moving through 5 main sections. We're going to start with the basics, the foundational concepts, and then we'll get into the more practical side of things like bank reconciliation, reporting, and finally actually executing those key adjustments. It's all designed to build your understanding step by step.
All right, first up, let's get a really solid understanding of adjusting entries. These are absolutely critical for making sure any company's financial reports are accurate.
Now, as this definition explains, the main purpose here is to make sure every transaction is recorded in the correct accounting period. There's a key rule to remember with these, and it's an important one. Every adjusting entry always affects 2 accounts. One from the income statement, say a revenue or expense, and one from the balance sheet, like an asset or a liability.
The source material breaks these down into 2 main types. On one hand, you have deferrals. That's when cash changes hands before the service or product is actually delivered. On the other hand, you've got accruals, and that's the opposite. The revenue is earned or the expense happens before any cash moves. The whole difference really just boils down to timing.
And you really can't overstate how important this is. The source guide is very clear on this point. If you skip these entries, it's not a small mistake. It will cause significant, widespread errors right across your financial statements.
To really see this in action, the FNSACC421 case study is a perfect example. A single mistake, just failing to record $1,000 in wages that were earned but hadn't been paid yet, well, that created a chain reaction of 6 different errors. As you can see, expenses were understated, liabilities were understated, and at the same time, net income and total equity looked artificially high. It just goes to show how one seemingly small omission can have a massive ripple effect.
Okay, now let's turn to the formal procedure for finalizing the books at the end of a period. This is what we call the closing process.
So according to the source, closing the books really does 2 things. First, it finalizes the accounts so you can prepare your financial statements. And second, it resets the books so you can start the next accounting period with a totally clean slate.
Now, this whole process relies on understanding the difference between 2 types of accounts. You have your permanent accounts, think assets, liabilities, and equity. Their balances just carry forward year after year. Then you have your temporary accounts. That's your revenues, expenses, and dividends. They only measure activity for 1 period, so at the end of the year, they get reset back to 0.
The source material lays out 4 clear steps to close the books. For steps 1 and 2, you're essentially moving the balances from all your revenue and expense accounts into a summary account. Then in step 3, you take the net result, your profit or loss, and you move that to retained earnings. And finally, step 4, the dividends account is closed out directly to retained earnings as well. This whole thing effectively clears out those temporary accounts for the new year, all while updating the company's permanent financial position.
Before we can even think about making these end-of-year adjustments, we have to tackle a really fundamental question. Are our cash records even accurate to begin with? And the answer to that lies in bank reconciliation. As you can see here, bank reconciliation in Zero is pretty straightforward. It's the process of matching up the transactions on your bank statement with the transactions you've actually recorded in your accounting system. Think of it as checking your work against the bank's records to make sure everything lines up perfectly.
And this isn't just busy work, it's an absolutely crucial control. The source highlights that it's vital for catching accounting errors, for spotting any funny business, like unauthorized withdrawals, and for just keeping a close eye on your cash flow. You know, cash is often the most vulnerable asset a business has, and this is one of the best ways to protect it.
Now, when you first do this, don't be alarmed if your bank balance and your company's records don't match up exactly. The source material explains that this is totally normal. It's usually just due to timing differences, like maybe you've written a check that the other person hasn't cashed yet. The whole point of the reconciliation statement is to systematically identify and account for these items to bring it all into balance.
Right. So once our cash is reconciled and we know it's accurate, the next phase is to generate a series of reports. These will give us a very clear financial baseline before we make any adjustments.
This reporting workflow is a pretty standard 3-step process. First, run the journal report to review all your transactions. It's like proofreading your work. Next, you generate your key financial reports, the trial balance, the balance sheet, and the profit and loss statement. That gives you the big picture. And finally, you use the info from the balance sheet to prepare your asset register.
Once that's done, you've got a complete and accurate snapshot of your finances before you go any further.
And here we are. We've reached the final section where we put all this theory into practice and actually execute the end-of-year adjustments for our case study, FNSACC421.
Let's kick things off with a deferred expense. The analysis here shows a payment for a 12-month subscription. The adjustment we need to make is to recognize 1 month's worth of that expense, which comes to $20. Now, if you look at the journal entry in Zero, you can see exactly how it's done. We debit the subscription's expense account and credit the prepaid expenses asset account, both for $20. This correctly shows that we've used up 1 month of that subscription.
Okay, next up, accrued expenses. This is where we account for costs the business has taken on but hasn't paid for yet. A classic example is employee benefits. For FNSACC421, the source points out 2 key accruals we have to record: provisions for long service leave and annual leave. These are benefits that employees have earned, so the company now owes them that value.
Here, the source material shows us the exact journal entry to record that long service leave liability. We debit the long service leave expense account, and we credit the provision for long service leave liability account, both for $1,000. This entry does 2 things perfectly. It recognizes the expense in the right period, and it creates a liability on the balance sheet showing the company owes this money.
And we see a very similar entry right here for the accrued annual leave. Once again, we're debiting an expense and crediting a liability, this time for $200. This is another perfect example of the matching principle in action. We are matching the expense of that annual leave to the exact period in which the employees earned it.
One more key adjustment to look at is the provision for doubtful debts. As the source explains, this is basically an estimate of the invoices that you think you're not going to be able to collect. The whole reason we do this is to recognize that potential bad debt as an expense in the same period that we actually made the sale. It's a core accounting concept. You have to match your expenses to the revenues they helped you generate.
And that brings us to the end of our procedural guide. We'll leave you with a final question to think about. Knowing how a single, small error can have such a huge, cascading impact, which of these processes, the bank reconciliation, the preliminary reporting, or the adjustments themselves, do you believe is the most critical to master to guarantee absolute financial integrity?